Hey guys, it's Max Convexity. I'm working on another video right now. I got sidetracked and didn't realize it was already 1 o'clock, but hey Jax, what are you doing? Every time I start a video, he wants to get in the middle of it. Good boy, Jackson. All right, let's look at these Defiance Option Strategy funds. Let's start with JEPY. These guys sold options at the 47.90 level for $24. So $47.90 is max profit because that's the same thing as a strike. It's the strike price. On a sold option, strike price is always max profit. The amount of premium you receive is always, that's what I would call the buffer. That's your downside buffer. So that means it can fall that far from your max profit and you still make some profit. So that's why, option sellers are looking for the highest amount of premium. They're trying to sell the most premium they can. Okay, anyway, so 47.90 less 24.46 is 47.65.54. So let's see what the market's doing right now. Right now, the current price is 47.76. Well, that's pretty good. It's 13 points in the money. But it's higher than the break even at 47.65. So that means we have some profit, and sure enough, we do. We have $176,000 profit if the market closed right now, and it's not going to close right now. It's open for another 2 hours. And let's see. Well, and what do you want to bet it's a max profit by the time the end of the day comes? Maybe not, but I mean, this morning's action was what you call a bear trap. Check with Mike, the tactical stock scalper, for confirmation on that. But what's happening here is retail traders put their stop losses below prior day's lows and below swings, below important levels that are obvious on the chart, important chart levels, let's just say. Well, anyway, hedge funds know that, market makers know that. They ran it down this morning to get that liquidity, to get those people's stop losses out. And then they ran it right back the other way. Think how bad you'd feel if you had a stop loss right here, and now it's up here. That's why I don't use stop losses. Stop losses are no good. I'll make a video on a better alternative to a stop loss sometime. But Jay and these guys don't use stop losses either. I get the point all the time, or the question, why don't these guys just put a stop loss? And when the market's flushing, well, and there's lots of reasons. It's too in-depth to go into at this point. But the main reason is because you never know when the market's going to turn around. But the second reason is because these guys are trying to capture the extrinsic premium, or the out-of-the-money amount. Well, the out-of-the-money amount is visually represented by the yellow box on the chart. So all we know for sure is that the yellow box on the chart, or whatever that amount of money is, will be zero by the end of the day. When you sell options, it's just a scheme to collect this extrinsic value. And when the option expires, extrinsic always goes to zero. There's no ifs, ands, or buts. It doesn't matter if the market goes up 10%, doesn't matter if the market goes to zero. The extrinsic always is yours to keep. That's the money you earn by selling an option. So anyway, and so these guys want to let it run to the end of the day because that's when the extrinsic is zero. If they covered it this morning, they wouldn't have caught all the extrinsic, for one thing, and for another thing, it would have been a bad trade. So, I mean, because it looks like these guys are going to make about a half profit, if not a little more. We shall see. The day's young. Let's look at IWMY. These guys trade Russell 2000 options. They sold options at the 1980 level, so 1980 is the max profit. They received $23.83. Call it 24. So take 24 away from 1980, you get 1956. So we want a close of the index somewhere between those two levels. Well, the current price is 1946, so that's 10 points less than 1956. So that means we would have to cover these options right now, if it were the end of the day, for $33.37, and we only got $23 for them, so that would cause a loss. That's why this is showing a loss right now. One thing to notice is these options don't expire till tomorrow, so we'll see what happens. Usually these guys use one-day options. Occasionally they use two-day options, but when I see the spreadsheet at the end of the day in the website, they'll update it and they'll tell us what they did, and I'll update my information as well. All right, but let's look at this chart real quick while I have you guys here. These guys trade Russell 2000 options. Here's a chart of the Russell 2000. Okay, and sure enough, it looked kind of like the chart of the S&P, but it had a vicious sell-off in the morning, a stop-loss hunt, also called a bear trap. Um, you know there's stops underneath this low right here. That's an important swing low, and underneath this one, and probably underneath yesterday's low, and they got all of them. These guys are slick. They got all those stops. So, all right, let's look at the last one, which is NDX. All right, so first we'll look at the QQQY, the NDX. So these guys sold options at the 16,820 level. They received $80, or $81. $81 is their buffer, so you subtract 81 from 16,820, you have this number right here. So we're looking for the market to be, higher than this number, but lower than this number, or maybe even right at this number. For max, for the best situation possible. So right now the market is at 16,790. Well, we need to be at least at 16,740. So yeah, we're doing well. We're in the money here. We made 1.3 million right so far, and if the market closed right now, we would capture, and realize about 2/3 of that, 827,000. Let's look at there's a chart of the NDX. Boy, this thing's going up. Wouldn't be all surprised if this was a max profit by the end of the day. All right, guys. I'll be back at the end of the day. We'll have a final tally, and I appreciate you guys. And I'm sorry this update was a little bit late. All right. Have a great afternoon.